Good evening, students. Today we are going to see the theory base of accounting. Already we have discussed at the time of learning the base, we have started learning basic accounting assumptions. Theory base of accounting based on basic accounting assumptions and basic accounting principles. In addition to that, it has got modifying accounting principle that we'll see later. Okay, first this already we have discussed. There are four basic assumptions. What are the four basic assumptions? Going concern assumption. Going concern assumption already we have discussed that it will go on for a long period. No businessman will start the business. It's going to complete within a period of 1 or 2 years. Everybody assumed it will be, the business will run for a long number of years. So under that assumption only, all the accounting process will be started. That's going concern assumption. Second thing, business entity assumption, or we can say separate legal entity assumption. Separate legal entity assumption means business is different, owner is different. Once a owner or businessman invests their money in the business, their account will be maintained separately, business account will be maintained separately. For example, if so many investors are there in one company, after some time, the company is going down in the business. That time, only the shares or money invested in the business will affect the investors. It will not affect their own personal property. So that is called as a business entity as a assumption, or the separate legal entity assumption. Separate legal entity assumption. Okay, the third one is money measurement assumption. That means each and every transaction should have the monetary value. If it doesn't have the monetary value, the transaction will not be treated as a business transaction and it will not be entered in the books of the accounts. Then accounting period assumption. Accounting period assumption assume that every business will get over with a period of 1 month to 12 months. Generally, 1st April to 31st March is considered as a financial year. Financial year, most of the business, they follow this accounting period. Some of them, they use the calendar year. That means 1st January to 31st December as the accounting period. Some of the people, they use according to their convenience, according to the religious belief or whatever may be. So accounting period assumption stress on the number of period where the business account should be closed and the information related to the progress of the business should be communicated to the concerned people. That probably the 1 to 12 months. This is called 1st April to 31st March will be considered as a financial year, and 1st January to 31st December is considered as a calendar year. So the person, those who are interested, according to their convenience, they'll fix their accounting period, and accounting period will be followed throughout the lifetime of the business. They will not change here and there. If necessary comes, for that necessary policies will be made and it will be followed. Now let us go to the basic accounting principles. This basic accounting principles based on the revenue recognition principle and historical cost principle and matching principle and full disclosure principle. Then we will come to the objectivity principle. Now let us see what is a revenue recognition principle. Revenue recognition principle talks about the earnings of the business. Earnings should match, should be done in the same accounting year, accounting period. For example, now let us take for a month. Suppose order was placed in the month of March. For example, goods was ordered by the third parties in the month of March, but delivery of the goods has taken place in the month of April, but they have not paid money. Receipt of the cash has taken place in the month of May. In this scenario, we have to take only this part as a earnings period. not ordered period or actual receipt of the money. So revenue recognition principle insists on the actual delivery of goods and services. Once the goods and services are delivered to the business concern, that time only it is treated as a business transaction is completed. Business transaction is completed only when the goods and services are delivered. So that this revenue recognition principle insists on the delivery of the goods and services. Only it completes the transaction, then only it is called as a revenue recognition principle. Now let us go to the second one, which is called historical cost. Historical cost in the sense the original cost of the material. For example, let us take a fixed asset. A fixed asset, for example, a furniture. Furniture was purchased for rupees, let us take 2000. A furniture sofa set was purchased for rupees 2000. And in the expenses column, what they are talking, cost. This cost will be shown as an asset in the balance sheet, in the statement of information, but we cannot take this as the entire purchase for 1 month. It will be taken to a number of years. As long as the business goes, the furniture account will be maintained at the original cost. Okay, the historical cost says that the original cost will be shown in the books of the accounts, but each year there will be, the furniture will be used and there will be some sort of a depreciation will be there. So that depreciation, they will fix, for example, 10% on the original cost. 10% on the original cost means that amount they will deduct at the end of the year and show this amount as the cost of furniture. This depreciation of 200 is shown as a expense. Expense, that means the utilization of the furniture during the year. So this 200 only will be shown as an expense in the profit and loss account, and this on the basis of 2000, the depreciation, that is the usage of the furniture, is shown, and the balance only taken to the next accounting period. So this is called historical cost. That means original cost assumption or principle, original cost principle. Third one is matching principle. Matching principle, let us say that expense should equal to revenue. Expense should equal to revenue. That means what? Now, suppose we are saying this is an expense. Likewise, when there were in the previous example, I told you goods delivered, goods and service delivered for worth of, suppose 200, let us assume goods worth of 200 delivered, and even though the cash is not received, it is considered as a revenue received. Even though the cash is not received yet, it is considered as a revenue received. So expenses must match the revenue. That means expenses, here we use this is expensive, I told you. That is from the original cost you have taken certain expense. This is a depreciation in the value of the asset. That means due to the usage of the furniture, it may go down in that value. That value we can calculate maybe 10% or 15%, whatever may be. According to this is called the expense for the during the year. And the previous example I told you, the sales was ordered for 200 rupees during the month of March, and it is delivered during the month of April, but the cash received only in the month of May. But it doesn't matter when it is received, but the effect taken place only in the month of April. That month we can take this revenue. That means the revenue expenses should match here we are talking about the matching, should match the revenue. But this is not always possible. There may be some adjustments will be made regarding this, and it will be taken to the account. So matching principle insists on the expenses is equal to revenue. Revenue is equal to expenditure or expenses. So each year when the accounts get closed, expenses should match the revenue. In certain exceptional case, it does not match, that they will do some adjustment. Then full disclosure. What do you mean by full disclosure? Once again, I'll recall whatever we have discussed. First of all, we said as a revenue only after receiving, only when the goods and services are delivered only it has got effective delivery, that means revenue received, and this is cost we said, and the revenue and cost should match, that come under the matching principle. Now let us go to the full disclosure. That means it is the duty of the the business organization to give the full details of the assets and liabilities to the public or the interested parties, that is owners and other people. Okay, these assets and liabilities should be shown exactly. It should be, for example, if the assets are, for example, machinery, every day we are using machinery, there may be depreciation in value. That may be calculated. Which method they are calculating? Which method of calculation they should express in the footnote. There will be a footnote at the end of the financial statements. In that footnote, they should insist which method they are using the depreciation. There are different methods. One is called original cost method. Another one is called diminishing balance method, and third one is annuity method. Fourth one is sinking fund method. There are different methods like this. Which method the business is following to show the expense? That means expense means depreciation. Whether it's in the original cost method or diminishing balance method or annuity method or sinking fund method. This information should be given here, given in the full disclosure. Okay, then what is next? Objectivity principle. Objectivity principle means every transaction should have the supporting document. Objectivity principle should have the supporting document. Supporting document for each and every transaction. Now let us say, for example, there are the documentary evidence like vouchers and receipts, and what else? Bills, invoices, and what else? Cash memos. Like this, there must be some documented evidence for each transaction. Then only it will be treated as a business transaction. If no evidence, no transaction will be considered as a transaction. So now once again recall basic as accounting principle, revenue recognition. Every delivery of goods and service takes place only the transaction is completed. That means revenue received. And historical cost for every original cost of assets, there must be some depreciation. That depreciation should be based on the original cost method. And matching principle, every revenue should match the expense. Full disclosure, all the information related to the stock taking, stock valuation, everything should be given in the footnote by the financial the person, those who are preparing the financial statements. Footnote saying that they have disclosed all the information to the investors and the owners, interested parties. Objectivity principle, supporting each and every transaction should be supported by each and every documentary evidence such as vouchers, receipts, bills, invoices, and cash memos. After this, we'll learn. Next, we'll go to the next in the next video.